All right, we're going to continue our discussion of chapter 14, in this case section 3. We're going to learn about the Federal Reserve System, or the Fed. The Fed has an incredibly important role in our economy, especially in today's pandemic. The Fed is doing a great deal to try to help our economy get back on track. The Fed was established in 1913 to serve as our nation's central bank. What does that mean? What is a central bank? Well, when you and I need to put our money away for safekeeping, we put it away at a bank. Bank of America or Chase or Wells Fargo or Ally Bank. Okay? When we need to borrow money, we go to a bank. But where does the bank go if they need to put their money away for safekeeping? Where do they keep a lot of that money that they get deposited? Where do they go if they need to borrow money? Well, they can go to this group called the Federal Reserve System, or commonly called just for short, the Fed. The Federal Reserve serves then as our nation's central bank. That is a bank for the banks. But how does the Federal Reserve System work? Well, first of all, it's not a government agency. As much as it might sound like a government agency, the Federal Reserve System, or the Fed, is actually privately owned. Okay? And it's a system of banks. It's not just one big, huge bank. It's a system of banks. That's why it's called the Federal Reserve System. The Fed is made up of individual member banks. Individual banks like Bank of America or Wells Fargo or Chase, they buy membership in the Federal Reserve. Much like you would buy membership in a gym, you become a member and then you can enjoy the benefits of being a member of the gym, using the equipment, going to the classes. As an individual member bank, they can now use the Federal Reserve System to store their money and to get loans. Okay? These individual member banks are the ones that actually own the Federal Reserve System. They buy stock or ownership in the Federal Reserve System to become a member. Okay? These individual member banks are then organized into districts. There are 12 districts spread throughout the United States. Okay? And each district has what we call a district bank. That is the main bank for that particular area. Okay? In California, we are in the 12th district. Okay? In 1913, a lot of the business and economic activity in the United States was taking place on the East Coast and in the Midwest. So a lot of the district banks are established in the Midwest and in the East Coast. There's a Federal Reserve Bank in Philadelphia, in New York. There's one in Richmond, Virginia. There's one in Atlanta, Georgia. There's one in Chicago, and in Minneapolis, and St. Louis, and Dallas. But our 12th district, our district bank is the 12th district bank, and it's located in San Francisco. So if you're a bank in California or Nevada or parts of Arizona, Utah, you would use the Federal Reserve District Bank in San Francisco. Okay? So it starts at the bottom with the individual member banks, and then it goes up to the district banks. I probably got it upside down from what is in the book. Then there's a group called the Board of Governors that oversees the entire Federal Reserve System. They oversee the entire system. There are 7 members of the Board of Governors. In order to become a member of the Board of Governors, you have to be nominated by the President. And then, as you know from your civics class, all presidential nominations have to get Senate approval. Okay, but these 7 individuals serve on the Board of Governors, and they oversee the operations of the Federal Reserve. Okay? One of those 7, and they serve for a 14-year term. One of these 7 individuals is chosen by the President to serve as the chairman of the Federal Reserve's Board of Governors. The chairman of the Federal Reserve is probably the most powerful man in the economic world. The book says the President, I can make an argument there, but I also could make an argument that the chairman of the Federal Reserve's Board of Governors is the most powerful man in the economic world because of all the influence he has over the economy. Okay? Our current chairman of the Federal Reserve is a gentleman by the name of Jerome Powell. And he was nominated and approved by President Trump. Okay? He actually took over for a woman, the only woman that we've ever had to serve as the chairwoman of the Federal Reserve Board of Governors, and her name was Janet Yellen. These are very, very smart individuals that have an economic and business background. Janet Yellen has PhD in economics and so forth. Jerome Powell, same kind of an idea. Very smart, very well-versed in economic ideas and concepts. These 7 members of the Board of Governors and 5 of the district bank presidents, so a total of 12 individuals, they make up the Federal Open Market Committee. Federal Open Market Committee. And they are responsible for deciding monetary policy. If we were to have a final exam, and we're not going to, there would be more questions on monetary policy and the Fed than any other topic in the book. That's how important their job is. And what is monetary policy? Monetary policy is the most important job the Fed has, and it is the Fed's ability to control the money supply. And by controlling the money supply, they can influence interest rates. And interest rates have a direct impact on economic activity. How does that work? Money is like any other object. It has a supply and a demand. Okay? So as you remember from before, okay, price on the vertical and quantity on the horizontal axis, the demand for money and the supply of money. Well, what is the price of money? Where would you go if you needed to buy some money? Well, you'd go to the bank. We talked about that in the last video. If you were to go to the bank, they would charge you an interest rate. To get a car loan, maybe 3%, 4%, 5%. To get a home loan, get a student loan. They're going to charge you an interest rate for that money. And that interest rate is considered to be the price of the money. So the demand for money, like all demand curves, slopes down and to the right. Because if interest rates are lower, you'll want to borrow more money. If interest rates are higher, you want to borrow less because it's more expensive. Okay? If I can borrow money at a low rate, I might borrow more money to buy a bigger house or go to a more expensive college or buy a more expensive automobile. But if the price of that money is higher, I'm going to demand less money and buy a cheaper home, a cheaper car, and so forth. The supply of money is a straight line. That's because today, in the United States, there's only so many dollars that exist. Whether interest rates are really low or really high, there's a fixed or a set amount of money that exists in the United States. Well, together, the supply and demand create, remember, the equilibrium interest rates or equilibrium price. Well, what does the Fed have to do with this situation? The Fed has the ability to control the money supply. And we're going to talk about how they do that in a minute. But the Fed controls the money supply. If the Fed were to increase the supply of money, if the supply of money were to go up, okay, what's going to happen? Well, if the supply of anything goes up, then interest rates, or the price of that item, I should say, is going to go down. And you'll notice that interest rates fall. This is called an easy money policy. One of the first types of monetary policy is an easy money policy. Under an easy money policy, the supply of money goes up, causing interest rates to go down. And how is that supposed to impact the economy? Well, as we learned just a few moments ago, if interest rates go down, people will borrow more money. Okay? 15 or so years ago, the economy was doing poorly. Okay, we were coming out of, we were in a recession, and so the Fed implemented an easy money policy, and they started to increase the supply of money, causing interest rates to go down. And Mrs. Ward said, "Wow, interest rates are really low. We could borrow money to remodel the house." And because interest rates were low, we took out a sizable loan and we remodeled the kitchen and we remodeled the upstairs and we added a master bathroom and we did a lot of different things. And how does an easy money policy and these lower interest rates help the economy? Well, people borrow more and they spend more, and that creates jobs. Okay? When the interest rates went down because of the Fed's easy money policy, I borrowed money to remodel my house. I had to hire an architect to design the bathroom. I had to hire a construction crew to build the bathroom. I had to hire plumbers and electricians. I had to hire cabinet makers to build the cabinets. I had to hire granite countertops, somebody to install those, and so forth. So I created a lot of, by my spending, I helped to create a lot of jobs. And an easy money policy is designed to fight a recession. So what do you think the Fed is doing right now as we're in this pandemic caused recession? The Fed is following an easy money policy to try to help stimulate or help the economy grow. Okay. Well, the opposite of an easy money policy is a tight money policy. And under a tight money policy, the supply of money goes down. Okay, if the economy, or if the Fed decreases the supply of money, that's called a tight money policy. The supply of money goes down, causing interest rates to go up. And if lower interest rates encourage borrowing and spending, well, what do higher interest rates do? As interest rates go up, that discourages people from borrowing and spending. And why would the Fed ever want to do that? Why would the Fed ever want to discourage people from spending? Well, a tight money policy is followed when we have an inflation problem. We learned in the last chapter, one of the causes of inflation is too much money floating around. And as too much money is floating around, that causes prices to rise, and that's not good for the economy. People can no longer afford to buy as many goods and services. So the Fed, when the economy is facing an inflation problem, is going to follow a tight money policy. Under a tight money policy, the supply of money goes down. The supply goes down, causing interest rates to go up. And this is the Fed's ability then to influence economic activity. If the economy is going slow and it's in a recession, the Fed is going to step on the gas and try to speed up the economy by implementing an easy money policy. The supply of money goes up, the supply curve shifts to the right, and interest rates go down. That's an easy money policy under a recession. The opposite would be a tight money policy. Under a tight money policy, the supply of money goes down, and the interest rates go up in an attempt to slow the economy down. Okay? So the Fed has a very important role in our economy. They get to decide, should they be increasing or decreasing the supply of money so as to influence economic activity. Well, how do they do that? How does the Fed increase or decrease the supply of money? They don't simply print more money, although sometimes it seems like that. One of the things that the Fed can do is change the reserve requirement. These are called the tools of monetary policy. And if you remember that formula from the last chapter, or last section, the Fed controls the money supply by affecting the reserve requirement. The Fed has the ability to control that percentage. We used 20% in the last video. So $100 on deposit at 20% makes the money supply grow out to $500. Well, what if the economy is doing poorly? What can the Fed do to that reserve requirement? They can lower it. If the Fed lowers the reserve requirement to say 10%, that will cause the money supply to expand even more. Again, you can check my math on the calculator. But 100 divided by a reserve requirement of say 10% will cause the money supply to grow even more. So if we're in a recession, the Fed is likely to lower the reserve requirement. If we're having an inflation problem, what is the Fed likely to do? Well, again, they would do the opposite. They would raise the reserve requirement to say 50%. If they changed it to 50%, that would cause the money supply to grow to only $200. And again, the money supply is now declining or going down. But the Fed doesn't do that very much. The Fed doesn't change the reserve requirement very often. What do they do more often? They use the other two tools of monetary policy. And the second tool is what we call open market operations. The Fed will be buying and selling government securities or bonds in the open market. Way back in chapter 10, we looked at these government bonds. Okay? I know it's not a bond, it's a 5x7 card. But the U.S. Treasury, when the government is short money, when they need to borrow money, and that happens pretty much every year because they have a budget deficit, how does the government spend money they don't have? Well, they sell these government bonds or securities. This is a U.S. Treasury bond. Okay? It costs $1,000 to buy it. It pays 2% a year, every year for the next 10 years. So the government is in essence borrowing $1,000 and they're going to pay it back in 10 years and they're going to pay 2% interest a year. Okay? Well, who buys these bonds? We talked about rich people buying them, talked about banks buying them. Well, the Fed also buys these bonds. So if the Fed is buying these bonds from the banks, okay, so let's say the bank was the original buyer of this bond. The bank is taking your money and they're loaning it to the United States government to earn 2% a year. Well, what if the Fed wants to get the banks to borrow or to loan out more money? Okay? The Fed might buy using cash, that money, cash money, they would buy the bond from the bank. So now instead of the bank having a bond, the bank has cash. What can they do with the cash money? Well, they could turn around and loan it out at say 3% or 4% or 5% to someone else to buy a car or to buy a house. So instead of the bank loaning the money to the government, where they don't put it into the economy, the Fed buys the bond from the bank. Now the Fed owns the bond, but the banks have cash. And more cash on hand means the money supply is going to grow. So when the economy is in a recession, the Fed is going to be buying. And in fact, the Fed has decided they're going to buy over $2 trillion worth of these bonds from the United States government this year. The Fed has said the government needs money, so we're going to pump money into the government. And what did the government do with that money? Well, they gave out loans to businesses, but they also gave out that stimulus money of $1,200 an individual, $500 for a minor child, and so forth. So the Fed is helping the economy right now by buying the bonds. The government is issuing the bonds and they need people to buy them. And in this case, the Fed is buying over $2 trillion worth of bonds to try to help the economy get better. Okay? So when the economy is in a recession, the Fed will be buying bonds or securities. And of course, the opposite would be true. If we were in an inflation problem, if there was an inflation problem and too much money was floating around, the Fed would sell the bonds to the bank. Instead of the Fed owning the bonds, the Fed would sell them to the banks, taking cash away from the banks, and that would cause the money supply to go down and help fight the inflation problem. So if it's in a recession, the Fed is buying bonds, but if it's an inflation problem, I'm not going to write that on the board, they would do the opposite. They would sell the bonds to the banks. So these bonds that the United States government sells every year when they need to borrow money, the Fed is one of the biggest buyers and sellers. Well, they are the biggest buyer and seller of these bonds. So when the government is borrowing money, the Fed is one of the biggest buyers of the bond, but they don't always hold on to them. Sometimes in an inflation situation, they would sell the bonds to the banks and take away cash from the banks. The third tool of monetary policy is what we call the discount rate. When you and I need to borrow money, we go to the bank. Where does the bank go to borrow money? Well, they get to go to the Fed. The discount rate is the rate at which the Fed will loan money to the banks. So if the bank needs to borrow money for whatever reason, and you can read the book to see some reasons, but if the banks need to borrow money, they can go to the Fed and they can borrow it at a very low rate called the discount rate. If the economy is facing a recession, the Fed would lower the rate to the banks. And that, just like any other consumer, if the bank can borrow the money at a lower rate, the banks would be encouraged to borrow more money. And now they have more money to loan out, and that helps the economy to expand. On the other hand, if the Fed was trying to discourage the banks from loaning, they would raise their discount rate. Okay? So those are your three tools of monetary policy. The Fed can change the reserve requirement, they can buy or sell bonds on the open market, and they can they can change the discount rate. They can either lower it or raise it. If we're having a recession, what three things could the Fed do to increase the supply of money? If we're having a recession, like we are today, the Fed is going to follow an easy money policy. They're going to increase the supply of money, causing interest rates to go down to try to encourage people to borrow and spend. What three things can they do? Well, they could lower the discount rate, they could lower the reserve requirement, or the Fed could be buying government bonds. All three of those things are ways of increasing the supply of money. They're an easy money policy. If the Fed wanted to slow the economy down because there was a recession, because there was an inflation problem, okay, like there was in the 1970s, 1980s, we had very high inflation, 12, 13, 14% a year. The Fed then would implement a tight money policy to slow the economy down by taking money out of circulation. What three things could they do? Well, it'd be the opposite. They would raise the reserve requirement, they would raise the discount rate, and they would be selling government bonds in the open market. All three of those things would be a tight money policy. The Fed's number one job then is to try to move the economy, to try to move it by speeding it up or slowing it down by following a tight money policy. And the Fed does this by controlling the money supply. This is known as monetary policy. And monetary policy is the number one job the Fed has. But it's not an easy job. Okay? Obviously, it seems like it'd be more fun to follow an easy money policy, because an easy money policy speeds up the economy. It causes the price of money to go down, and that encourages people to borrow and spend, and that's way more fun. If I could buy a bigger house, a better car, go to a more expensive college, I could take and remodel my home. As interest rates go down, that's more fun. People like to spend money. But you could see if the Fed continually pumps more and more money into circulation year after year to try to keep those interest rates down, what happens when there's too much money in circulation is that we have prices rising. Okay? That's called the quantity theory of money. If too much money is floating around, that's going to cause prices to rise, and that causes inflation, and that's a problem. So it's kind of like a tightrope. The book calls it a dilemma. The Fed is kind of on a tightrope. They want to speed the economy up, but if they lean too far in speeding the economy up, they'll fall off. And then they have to slow the economy down. If they slow it down too much, well, that's what a recession is, if the Fed is slowing the economy down. So the Fed is kind of trying to stay in the middle. They want the economy to grow, but they don't want it to grow too fast so that we have an inflation problem. And we're going to look a little bit more at this problem in the next chapter. But think about that. The Fed is trying to speed the economy up, but not too fast. Okay? They have to slow the economy down sometimes, but don't slow it down too much because that causes a recession. So they're constantly trying to find that balancing act. Okay? Far and away the most important job the Fed has. That's why I said is monetary policy. That's why I said earlier that Chairman Powell and the Federal Reserve are incredibly influential in our economy. Chairman Powell, has the ability to decide monetary policy. Are they slowing the economy down? Are they speeding the economy up? And so forth. Okay? Monetary policy, very, very important in our economy, but it's not the only job that the Fed has. The last 2 pages of the chapter talk about other responsibilities that the Fed has. The Fed is responsible for maintaining the currency. What happens if this money is damaged, or it's written on, or somehow destroyed? What does the Fed do? Well, the Fed is responsible for replacing it with new money. So the banks send the old and damaged money to the Fed destroys it, and they replace it with brand new money. The Fed is also responsible for maintaining what we call the payment system. How do all of our payments get made? Well, in the old days, we used to write checks, and we still can write checks. But today, a lot of it is done electronically. Okay? I paid my house payment the other day electronically. I went online and did it electronically. Okay? Maybe you use Venmo or Zelle. Those are electronic payments. Well, all of those electronic payments and that system of making payments through the banks is organized, or I should say, regulated by the Federal Reserve System. The Fed is responsible for the payment system. And the last thing they do is they regulate or supervise the banks. The banks have a lot of rules that they have to follow. Who makes sure that they follow those rules? It's the Federal Reserve System. For example, we talked about the reserve requirement being, say, 20%. Who makes sure that the banks keep that 20% in reserve? It's the Federal Reserve System. So the Federal Reserve System has a very, very important role in our economy. Okay? They get to decide monetary policy and these other things, and that has a direct impact on how the economy is doing. Today, we have the pandemic-induced recession, and maybe a really, really bad, and maybe a depression. So what is the Fed doing to try to help the economy along? Well, they're making loans available to banks and other financial institutions. They're making loans directly to businesses. That's unprecedented. The Fed is also buying trillions of dollars worth of government debt to give that money to the government so that they can loan it, or give it to us, I should say, not loan it to us, but give it to us in the form of direct economic stimulus. Okay? So the Fed is one way, or the Fed and monetary policy is one way in which we can try to fix the economy. What can the government do? Well, you have to stay tuned until next week. That's chapter 15. And fiscal policy, what the government can do to try to help the economy along. All right, stay safe. Please do the quiz. Again, if you're trying to improve your grade, use the book. All the answers are directly in the book. A couple of them here from the videos, but the answers are in the book. Use the book when you take the quiz. Okay? And please turn in the quizzes. Thank you, stay safe, and we'll talk to you again next week.